Welcome to Cool Cash Cows. I'm Cool Cash Cow Samantha, and here's a big money moo-moo to you for joining our Cool Cash Cow community and making money online with us today. In this video, we will be breaking down residual income valuation versus residual income accounting. But before we get into that, go ahead and slap that subscribe button and bell icon so that you miss out on none of our money-making secrets. Now let's jump right into it. Residual income valuation versus residual income accounting. The concept behind residual income valuation, sometimes referred to as residual income model or residual income technique, is that the value of an organization's stock is equal to the present value of future residual incomes discounted at the appropriate cost of equity. Analysis of residual income valuation. The primary suspicion hidden remaining pay valuation is that the income created by an organization should represent the genuine expense of capital, i.e., both the expense of obligation and cost of value. Albeit, the representing total compensation thinks about the expense of obligation, premium costs are remembered for the estimation of net gain. It doesn't consider the expense of value since the profits and other value dispersions are excluded from the total compensation computa cost. Because of the above reason, the total compensation doesn't address the organization's monetary benefit. Also, at times, in any event, when an organization reports bookkeeping benefits, such benefits might end up being monetarily unbeneficial after the thought of value costs. Then again, remaining pay is the organization's pay adapted to the expense of value. Recall that the expense of value is basically the expected pace of return asked by financial backers as pay for the open door cost and comparing level of hazard. Subsequently, the worth of an organization determined utilizing the remaining pay valuation is for the most part more precise, since it depends on the monetary benefits of an organization. Advantages of residual income valuation. By and large, lingering pay valuation is appropriate for mature organizations that don't give out profits or follow erratic examples of profit installments. In such manner, the lingering pay model is a practical option in contrast to the profit rebate model, DDM. Moreover, it functions admirably with organizations that don't produce positive incomes yet. Notwithstanding, an expert should know that such a methodology depends for the most part on forward-looking suppositions that can be controlled or are inclined to different inclinations. Alongside the limited income, DCF model, lingering pay valuation is one of the most perceived valuation approaches in the business. Albeit the methodology is less notable, the remaining pay model is generally utilized in speculation research. Note that lingering pay valuation is a flat-out valuation model that plans to decide an organization's inherent worth. Comparing residual income valuation and residual income accounting. Number 1. There are two ways to value a company: residual income valuation and residual income accounting. Residual income accounting is the process of calculating the value of a business based on its cash flow, while residual income valuation is the process of determining a business's value based on its future cash flow. Number 2. A residual income valuation compares the current market capitalization, stock price, with an estimate of future earnings streams and cash flows. A residual income accounting approach assumes that there will be no change in future earnings and cash flows, which is why it's more common to use for public companies. Number 3. Residual income valuation is a method of calculating the value of a business by comparing the cash flow from operations with its total fixed costs. In contrast, residual income accounting is an accounting method used by businesses to measure their results for a given period. The business's assets and liabilities are valued at market value or replacement cost at the end of the period, while its equity is valued at book value. Number 4. Residual income valuation is a method of valuing a company's future net income that is left after all operating expenses have been paid. Residual income accounting is the process of determining the value of a company given its projected net profit and operating expense. Number 5. Residual income valuation is an often used method to calculate the value of stocks, bonds, and other securities because it considers the value of future cash flows rather than the cost of past capital investments. Residual income accounting is used by companies to determine their worth based on projected income statements, balance sheets, and cash flows. Residual income accounting, or residual income valuation, is the practice of accounting for the income left over after a company has paid all its expenses. Residual income valuation differs from residual income accounting in that residual income can be measured by looking at a company's cash flow statement and evaluating profits earned from sources other than its normal operations. Number 7. Residual income valuation is a method of valuing a company's future cash flows, while residual income accounting is the method used to report those same future cash flows. The two may look similar on the surface, but they are actually quite different, and it's important to know the difference if you're going to invest in a business or business-related idea. Residual income valuation looks at what a company will earn over time based on existing operations and any possible growth opportunities. It then compares this projected earnings with its debt level and other sources of financing, such as equity. From that point, it determines how much money the company will have after each period, typically 1 year, has passed, so that it can calculate how much money it needs to generate each period in order to cover all of its expenses, including interest payments on existing debt, and reach break-even. Once you have determined your break-even point, you can see if you want to continue investing in your idea or whether it's better off going out of business entirely. Residual income accounting looks at a company's current assets and liabilities as well as its projected cash flows over time, then compares these numbers with what they expect their various investors and creditors will give them once funds. Number 8. Residual income valuation and residual income accounting are two different methods of calculating the value of a company's net operating income. The difference between the two is that residual income accounting uses a set of rules to determine how much money a company can expect to make on its current operations, whereas residual income valuation does not rely on any rules or assumptions about future profitability. It simply looks at how much money the company has made in its past and then estimates what that number will be in the future, assuming no change in either its revenue or expenses. Number 9. Residual income valuation is a method used by businesses when they want to know how much money they can expect to make in the future based on their current business model. Residual income accounting is used by accountants when they want to see how a business's current financial position compares to what it would have been if it had operated at full capacity all year round. Number 10. Residual income valuation is a method of accounting that looks at the income that a company receives from its normal operations, while residual income accounting uses the same method to account for the gains or losses on investments. In the case of residual income valuation, companies are able to adjust their earnings because they have access to information about how much money they made in each category of business. Residual income accounting, on the other hand, only considers one set of numbers, profit. Number 11. Residual income valuation measures how much money a company makes after all costs have been paid. Residual income accounting measures what remains after all expenses are paid, including interest on debt and taxes. Residual income valuation is based on assumptions about how much money will be made in the future. Residual income accounting is based on actual numbers from past years. Number 12. The key difference between the two is that residual income accounting is based on the idea that all costs can be accounted for in a single, straightforward calculation. Residual income valuation, on the other hand, takes into account both the cost and revenue of an enterprise, allowing it to calculate what percentage of profit will remain after everything else has been covered. This distinction matters because it affects how companies report their financial results and how investors value them. Number 13. Residual income valuation is a method of determining the value of a company's assets, including its market share, brand equity, and intellectual property. This is done by looking at the ROI, return on investment, that customers have made in your products or services over time. It's important to note that this valuation doesn't take into account any financial information, only customer behavior. Residual income accounting is the way companies report their finances each quarter or annually. Residual income is usually calculated as net income after taxes, but some companies use it as an additional metric for evaluating performance. For example, if a company's gross margin is higher than its operating expenses. Here are a few last thoughts. The two terms you'll hear most often when it comes to residual income are residual income valuation and residual income accounting. The former is used in situations where you're trying to figure out whether or not a company's earnings are enough to make it worth investing in. Residual income accounting, on the other hand, has to do with how much money your company makes after taxes are taken off the top line. It's typically used when determining whether or not it's worth it for you to invest in a business. So, these were all about residual income valuation versus residual income accounting. For more money-making secrets, click the video on the screen now, or click the links in the description below.